All right, we got to talk about inflation, the jobs report, the Fed, interest rates. What is going on? We just got a report out of the Philly Fed this week that is like, what is going on? What is the Federal Reserve doing? What is the Bureau of Labor Statistics doing? What is the Biden administration doing? Rick Scott from Florida says there may be some funny business going on. We'll talk about all of that in this video. But first, I want to remind you to visit our sponsor, Mike Lindell, MyPillow, MyPillow.com. For all the best deals for the LFS6B audience, go to MyPillow.com/LFS6B and use our code LFS6B at checkout. All right, folks, we've been talking about inflation for a very long time. We've been actually ahead of the curve. You look at these Fed governors, I've been complaining about it. They couldn't have been more wrong. Back in November of 21, when everything was surging, real estate was surging, commodities were surging, we were still printing money, we were still effectively at zero interest rates. Everybody was saying, hey, you know, we might want to get off zero here soon enough. All these Fed governors all over the country, don't overreact. It's going to be transitory. Don't worry about inflation. We need the economy to do this. We need the economy to do that. We're not going to get off zero yet. Don't overreact. Kashkari and Bloomberg. Let's not overreact to early small interest rates, small inflation numbers. We can't overreact. We're not going to raise rates. The dot plot where all the governors tell us where they think the federal funds rate's going to go, I think in 2022 had maybe a quarter point raise in the federal funds rate to get us off of effectively zero. We have now raised 475 basis points in 2022 because inflation was out of control. And as I told you 2 years ago, when inflation gets out of the bottle, it's extremely hard to put it back, and now we're seeing that. Federal funds rate has now raised 475. The Fed says we're not done. We're going to have to go over 5 for the terminal rate, maybe even 5.25. We have to get inflation under control. Meanwhile, the Fed acts with lagging indicators. But one of the sticking points to the Fed raising rates, and one of the things we keep hearing from Jerome Powell in every one of these Fed meetings now that we've all been so accustomed to and we've all now have such interest in, is the labor market. And the labor market's very tight. The labor market's very tight. That's the one thing that we can't get a hold of to try to get inflation down. Services and the labor market. The labor market is extremely tight. We keep hearing all these jobs. 1.14 million jobs created in the second quarter, they told us. Bureau of Labor Statistics, 1.14 million jobs created in the second quarter of 2022. Fed continues to raise rates. Well, take a look at this from the Philly Fed. Early benchmark revisions of state payroll employment released, as you can see over here, December 13th, 2022 in the upper right-hand corner. December 13th, that's just a week ago. Early benchmark for all 50 states in the District of Columbia. Let's take a look at this. Estimates by the Federal Reserve Bank of Philadelphia indicate that the employment changes from March through June, that's Q2, 2022, were significantly different in 33 states in the District of Columbia compared with the current state estimates from the Bureau of Labor Statistics, current employment statistics. Early benchmark estimates indicated higher changes in 4 states, lower changes in 29 states in the District of Columbia, and lesser changes in the remaining 17 states. Our estimates incorporate more comprehensive, accurate job estimates released by the BLS as part of its quarterly Census of Employment and Wages program to augment the sample data from the BLS CES that are issued monthly on a timely basis. All percentage change calculations are expressed as annualized rates. And then here is the key, folks. In the aggregate, let me zoom in here so you can see it. In the aggregate, 10,500 net new jobs were added during the period, rather than the 1.121 million 500 jobs estimated by the sum of the states. The U.S. CES estimated net growth of 1,047,000 jobs for the period. So instead of growth of 1,047,000 jobs for the period, the growth was actually 10,500. So they were only off by 1 million jobs in the second quarter. Payroll jobs in the nation remained essentially flat from March through June. We haven't heard that from the Fed. We haven't heard that at all. We've heard that the labor market is extremely sticky. The labor market is extremely tight. The labor market we have too many jobs, too few people. This is a big cause of inflation, that, and obviously services. CPI, 33% of the CPI, of course, is owner's equivalent rent. Mortgage rates have gone up because the Fed keeps raising. More people forced into renting. Fed says we have to get above 5. We don't see inflation coming down to our 2% anytime soon. We're going to have to leave the 5% there for a long time. And now we see this report that the job growth we were told was 1 million jobs, that the Fed's telling us the labor market's so tight, was actually only 10,500. What does that mean? We're raising into already a flattening and almost dead job market, and we're raising rates still at the same pace that we thought we were creating 1 million jobs in Q2. Now, someone who would have a really good idea of what's going on with inflation in real time and how inflation has really started to come down way more than the Fed does on their lagging indicators would be Elon Musk. Obviously, with Tesla, he's in tune with shipping, chips, parts, all different sectors of this economy. And in a response to someone who said that him being at Twitter is obviously affecting Tesla as it hits a new 52-week low yesterday, he says maybe so, in which case buying opportunity. Of course, he's talking about Tesla there. But then he says the following: I keep saying that the Fed rate is insane because data I'm seeing says we're already in deflation. Data I'm seeing already says we're in deflation. If true, then real rate of return on Treasury bills is roughly that of the S&P 500, which is probably roughly right now, if on the short end, is probably about 3.8, 3.9%. Very smart investor I spoke to today says he's shorting the S&P. And this goes along with a lot of people's talk about the S&P going into the new year and where it probably needs to be, where earnings need to come into. A lot of people are calling for an S&P back around 3,300, maybe even as low as 3,000. But the key here is what he's saying here. The data I'm seeing says we're already in deflation. So folks, if people on the ground who are really in the economy, like Elon Musk, are saying, we're already seeing deflation. Prices are plummeting on these things. Shipping containers. You can see the chart in shipping containers where we're at. We're way deflationary on shipping containers. But the Fed is raising rates, saying we have to go above 5. We have to stay there. And the jobs report is 1 million jobs off. How does that affect their thinking? How would that be different if they knew, if we had this information, timely information that was accurate? Would the Fed have raised 50 basis points? Maybe they would have raised 25. Maybe they would have said, hey, we need to stop and look around here at what's going on. But if they think that we created 1,147 in quarter 2 when we actually only created 10,500 and the job market was flat, then Elon Musk is right. The Fed rate is insane. And we're all going to pay the price of it. A couple other things here. Gary Black says, in my opinion, the Fed is making a huge mistake in pushing the federal funds rate to 5% or higher, with inflation already receding. The bond market sees it too, with the 10-year treasuries at their largest spread versus the 3-month treasury bills yields in at least 40 years. And by the way, the 10-year to 3-month, if you don't know, is one of the absolute most important things the Fed looks at. The 3-month to 10-year is one of the things they like the most to look at. And of course, the bond market has been telling the Fed all along, enough is enough. If you followed the 2-year, which is really what the Fed usually tries to follow, the 2 and the 10 have been in the inversion on the 2s to 10s, and the inversion here on the 10-year to 3-month, as Gary Black and Elon Musk are saying, the Fed's making a huge mistake. They're raising rates without stopping to look around at real data. As Professor Jeremy Siegel from the Wharton School says, they need to take the Case-Shiller home information and lay it on top of what they're saying because they're working on lagging data. This is absolutely crazy. One more from Gary Black. I'm in Elon Musk camp that the Fed is risking huge damage to the U.S. economy by raising the federal funds rate above 5%, shown by the December dot plot. Inflation is already falling. We expect Friday's November PCE deflator month-over-month 0.1, core to be 0.2 to reinforce the recent downward trend. And by the way, this is not the first time we've seen this. If you've been paying attention, look at this headline in Zero Hedge. BLS job revisions show every job report in 2021 was absolute total garbage. The BLS made huge revisions in the number of monthly jobs dating all the way back to 2017. BLS job levels revision by month data from BLS chart for 2021. And if I zoom in here, you can see the adjustments from 2021. So this is not the first time we've seen this kind of nonsense from the Bureau of Labor Statistics. Here's another article in Zero Hedge about the problem that we continue to see from the BLS. Regular readers are well aware that back in July, Zero Hedge first pointed out that a gaping 1+ million job differential had opened up between the closely watched and market impacting, if easily gained and manipulated, establishment survey and the far more accurate, if volatile, household survey. See, the establishment survey is what the politicians like to use because those numbers, again, are always usually wrong to the upside, so it makes them look better. That's what Biden's been using. That's what Rick Scott's been saying. Hey, you guys are playing funny business leading into the midterms with these numbers, and he wants some answers. The establishment survey as opposed to the household survey, the two core components of the monthly non-farm payroll report. We first described this divergence in early July when looking at the June payrolls data. We found that the gap between the housing and establishment surveys had blown out to 1.5 million starting in March when something snapped, quote unquote. We described this in their article, Something Snapped in the U.S. Labor Market. Since then, the difference only has gotten worse and accumulated earlier this month when the gap between the establishment and household surveys for the November data set nearly doubled to a whopping 2.7 million jobs, a bifurcation which we described in another article they put out. Whether this divergence was due to wrong seasonal adjustments, a remnant of the overreaction taken by the Department of Labor following the COVID crunch to normalize for a few normal labor markets, due to the erroneous birth-death assumptions. Here, too, the Department of Labor was assuming early cycle new business creation, which clearly is wrong with the economy late cycle and millions of businesses shutting down, ignoring the open PPP fraud that took place in the early mid-2000s as everyone opened up businesses to get free money from the government due to the establishment survey inability to tell the difference between full, part-time, and multiple jobs. As a reminder, we first showed this since March. The U.S. had lost 400,000 full-time jobs offset by far lower paying part-time jobs as well as double-counted multiple job holders. Due to the record high rate of estimation, recall the 49% establishment survey response rate was much lower than the 70 to 75% rate typical in November, meaning the Department of Labor was literally making numbers up to complete the survey. And there you have it, folks. 1.1 million job creation in quarter two became 10,500 on the revised numbers. Meanwhile, we have a Federal Reserve that has been wrong about everything, wrong about inflation, wrong about transitory, wrong about the dot plots, wrong about how much we have to raise, and now are actually raising rates with numbers that can't be trusted. Meanwhile, we're the ones who pay the price in mortgage rates, credit card rates, the cost of capital, and it continues as the Fed tells us we're not done yet. All right, as always, we'll keep an eye on this, but I want to remind you to visit our sponsor, Mike Lindell, mypillow.com/LFS6B. We ask if you're going to shop there, use our code LFS6B at checkout for 10 to 60% off. All right, thanks, everybody, and I'll see you in the next one.